Welcome to this first lesson of the third topic in financial accounting, and the lesson is called Accounting for Asset and Liabilities. So this is the third topic. We are doing CPA foundational level. So this is the third topic of financial accounting, and the topic is called Accounting for Assets and Liabilities. And in this lesson, we are going to learn about a class of asset called property, plant, and equipment, which is usually classified under non-current asset. Then we are going to learn about their recognition, their measurement at recognition, then their subsequent measurement. So we are only going to discuss the three objectives, that is what property, plant, and equipment are, their how they are recognized. So that is the initial recognition, and then the measurement at recognition, and then the subsequent measurement of property, plant, and equipment. So kindly subscribe, and if you subscribe, of course, you can get free summarized financial accounting notes and answers to custom past paper questions from 2015 to 2023. You can contact us through the email samagatudu20@gmail.com or samagatudu19@gmail.com. These resources will help you in preparation and revision of the next CPA financial accounting exam. So, what are property, plant, and equipment? And we say that property, plant, and equipment, these are tangible items that are held for use in production or supply of goods and services, for rental to others, or for administrative purpose, and are expected to be used for more than one period in the organization or in the business. So we can say in the business. So any tangible item which is held by the business for production or supply of goods and services, or for rental to others, or for administrative purpose, is classified under non-current asset. And so we can give examples of this non-current asset. So examples of non-current asset. Examples of this property, plant, and equipment which are classified as an current asset. So, and the first example we have, you can have land. The first example is land. This is the land of the business where the business is being conducted. So, the land is an example of property, plant, and equipment. Another example is machinery. Machinery are used in the production. Machinery are used in the production of goods in the business. So machinery is another example of property, plant, and equipment. You can have motor vehicle. You can have motor vehicles. Then you can have furnitures. Furnitures in the business. Furnitures and fittings. And then you can also have buildings. For example, the office building where you are conducting the business. For example, the office building, the factory building where you are doing the production work. So these are some of the example of property, plant, and equipment. If you look at all these examples, you find that they are either used in production or supply of goods and services, and some you can lend. For example, some motor vehicles can be rented, or some machinery can be rented. Even land you can lend. Uh, Even building, you can have building for rentals, and for administrative purposes, and these are expected to be used for more than one period. These are These property, plant, and equipment, they are used for more than one period in the business. So they are not easily converted into cash. They are not easily converted into cash. Then we go on, do you recognize an item of how do you recognize an item of property, plant, and equipment as an asset? And we say that an item of property, plant, and equipment should be recognized as an asset if and only if the future economic benefit associated with that asset will flow to the organization and the cost of that asset can be measured reliably. So, uh, an item of property, plant, and equipment shall be recognized as an asset if and only if it is future economic benefits, future economic benefits will flow to the business or to the organization, and the cost of that asset can be measured asset can be measured reliably. For example, if you have a building and there's no way that that building will benefit your business or your farm or your organization, then that building cannot be recognized as an asset at a property, plant, and equipment. If you have motor vehicle and that motor vehicle will not bring any future economic benefit to the business, then it cannot be recognized under property, plant, and equipment. You only recognize those items which will bring future economic benefit, and you only recognize them when their cost can be measured reliably. When their cost can be measured reliably. Then we go to the second objective, which is the determination of the asset carrying amount. And we say that the carrying amount of an asset is the value of an asset at any given time. So the carrying amount of an asset is the value of an asset at any given time. The carrying amount of an asset is the value of an asset at any given time. So, during the measurement at recognition, you can value the carrying amount of the asset at cost. So, at the initial recognition or the measurement at recognition, an asset, the asset of property, plant, and equipment, of property, plant, and equipment is measured at cost. It is measured at cost. And there are some elements which are included in the cost of this item of property, plant, and equipment. And this element which should be included under the cost of property The first element, we have the cash price. The first element is the cash price less any discount. The cash price less any discount. For example, if you want to purchase a machinery which is going to be used in the production goods goods in the organization, then you're going to recognize it as the cash price less any discount. For example, if that machinery cost cash 2 million, if it costs cash 2 million and you are given a discount of 100,000, then the cost that you should recognize uh, at the initial recognition is going to be 1.9 million, because it is the cash price you raise any discount. So it is the cash price you raise any discount. Then the second element of the cost is any import duty, or direct taxes paid. For example, you purchased this machinery from another country and you paid an import duty of, let's say you paid an import duty of 100,000 and you paid direct taxes of another 100,000. So now the cost of your machinery has increased from this 1.9 million, because this now is the cash price you just discount, but you have paid an import duty and other direct taxes. Direct taxes include, for example, taxes like VAT or value added tax. So if you have paid an import duty of 100,000 and then you have paid direct tax such as VAT of 100,000, so now the cost of your machinery has increased now from 1.9 to 2.1 million to 2.1 million, or 2,100,000. The other element of the cost of an item of property, plant and equipment, the other element is any cost incurred to bring any cost incurred to bring the item, or to bring the item of property, plant and equipment to it is it is useful state. Any cost incurred in bringing the item of property, plant and equipment to its useful state is also another element of the cost which is measured at recognition. So these costs, they include installation costs, professional costs. For example, if you have bought this machinery and you invite a professional to install the machinery in your organization so that it can start working as expected, then that professional obviously is going to charge you installation cost. He also charge you his professional fee. For example, if he charge you an installation cost of 100,000, so this is the installation cost, and he charge you a professional fee for the installation of another 100,000, then the cost of your property, plant, and equipment now has increased from 2.1 million or 2,100,000 to 2 million, 2,300,000 to 2,300,000. The final element of the cost are the final element of the cost which is recognized or which is added or which is a part of the cost of property, plant, and equipment during the initial stage or during the measurement and recognition is the initial estimated cost of dismantling the item of property, plant, and equipment, and restoring the site to its original state. So at recognition, the firm or the business has to estimate the cost of dismantling that item of property, plant, and equipment at the end of its useful life. For example, if this machinery that we bought has an useful life of 20 years, so you expect that after 20 years, that uh, machinery is going to be dismantled and the site or the land where it is installed is going to be repaired or restored to its original state. So that estimated cost the of dismantling the property, plant, and equipment item and restoring the site to its original state is also a part or an element of the cost which is recognized uh, at the initial stage. So, for example, if the estimated cost of dismantling the property, plant, and equipment is 100,000, so you can say if this cost is, for example, 100,000, so you can see now your the cost to be recognized in your books or in the statement of financial position has now increased now to 2.4 million. It has now increased to 2.4 million. So these are the four elements of the cost of property, plant, and equipment at the recognition stage. Then we go to measurement after recognition. You have measured the value of your asset during recognition. Then how do you measure the value of the asset after recognition? And after recognition, we are talking about subsequent. It is also called subsequent measurement. Subsequent measurement. And we say that after recognition or during subsequent measurement, uh, the value of an item of property, plant, and equipment is measured at its carrying amount. It is measured at its carrying amount, and the organization, or it's measured at its carrying amount or the revalued amount, and the organization must choose either the cost model or the revaluation model to measure the value of an item of property, plant, and equipment during the subsequent measurement. So what is the cost model? The cost model simply means the cost of the item. So it simply means the cost of the asset, And when you remember, we are talking about property, plant, and equipment. So it is the cost of the asset less any accumulated depreciation, less any accumulated depreciation, and impairment and impairment losses. It is the cost of the asset, you less any accumulated depreciation and the impairment losses. For example, if we can give the example, let us say that this machinery, we bought it on January 2021. So in January 2021, we are going to recognize, so you can say the cost. So in January 2021, the cost, so here we can say, the cost. Then here we can say we have the book value. So the cost in January 2021, we have seen it is 2.4 million. Assuming that each year, the depreciation charge for each year, we can assume is 20,000, which means that now the book value, so this is at January, and then this is at December. So this is at Jan, then this is at Dec. So the book value, if there's no any impairment loss, if the impairment loss are zero, so the book value in December 2021 will now be 2.4 million. You deduct 2.4 million, you deduct 20,000, which will be 2,380,000. So in December, now in January 2022, the cost still remain the same, but here the book value now can still have the book value. So the book value. So here is the cost. The cost now in January 2021, the book value is 2.4 million. So assuming we are using the straight line method of depreciation, so here the book value in January 2022 is 2.38 2,380,000, but the cost still remain the same, so we can put the cost still remain the same. So if you're using the straight line method of depreciation and the depreciation per year is 20,000, so now in the second year of 2022, the accumulated depreciation now is 40,000 because it is the 20,000 plus another 20 for this year now, 40,000. So the book value, if the impairment loss, if there's no any impairment loss, then the book value at December 2022 will be 2.4 million. Remember here we are using the straight line method of depreciation. Will be 2.4 million minus 40,000, which we get 2,360,000, which will be now the opening book value in which will now be the opening book value in January 2023, 2,360,000. So the accumulated depreciation now for this year, now it is 40,000 now plus another 20. So it is 60,000. It's 60,000. If there's no any impairment loss, or for example, if there's impairment loss, for example, of 10,000, then the book value at December 2023 will now be 2,400,000 minus will now be 2,330,000. 2,330,000. So this is the cost model. You're saying it is the cost of the asset, less any accumulated depreciation and any impairment loss. Of course, here we are assuming that we are using the straight line method of depreciation, but in the next lesson we are going to see the different methods of depreciation. We're going to see the different methods of depreciation. Then the other uh, model, the other model of measuring the carrying amount of an asset after the initial recognition is called the revaluation model. And the revaluation model will simply say that the asset is carried in the books at a revalued amount which which is the fair value of the asset, which is the fair value of the asset less any subsequent accumulated depreciation and impairment losses. So revaluation model simply means that now the asset is being revalued by a professional valuer. The asset is being revalued by a professional valuer, and this model is used when the fair value of the asset can be measured reliably. So we can say that this method is used when the fair value of the asset can be measured reliably. For example, if we give we still use the same example. So in January 2021, you bought this asset and the cost was 2.4 million. So at December, a professional valuer comes and says that the value of the asset now is 2.5 million. It's 2.5 million. Therefore, in this case, you find that you have in this case you find that there's a revaluation. In this case, you find that there's a revaluation. There's a revaluation there's a revaluation gain because the asset initially cost 2.44 million, but the fair value at the end of January 2021 is 2.5 million. Therefore, there's a revaluation gain of 100,000. Then, if in the next year this asset is not revalued, if in the next year this asset is not revalued, so the book value of the asset at 1st January 2022 is 2.5 million. If this asset is not revalued and the depreciation for that year, so there's no revaluation in that year, and the depreciation for that year is, for example, 20,000, is for example 20,000, and there's impairment loss of 10,000, then you find that the value of that asset now is now the revalued amount. This was the revalued amount at December 2021 minus the accumulated depreciation during the year of 2022 and the impairment loss. So we get that the value of the asset now becomes the value of the asset now becomes 2,470,000. So now that is the value of the asset and December 2022. So in the next year of 2023, because revaluation has to be done regularly to make sure that the value of the asset is being measured on regular basis and it does not differ materially. It is not so different from the carrying amount. So if in December 2023 the valuer comes again and measures the value of this asset, so we have the carrying value in January 2023 is 2.4 to 2,470,000. Then the valuer has come and say that the value of the asset now is 2,670,000. Therefore, in that case, you find now there's a devaluation gain in that year of 200,000. So this is how revaluation, this is how the revaluation methods work. This is how the revaluation methods work. So this revaluation gain is recognized under the equity section of the statement of financial position. So it is recognized under revaluation surplus under the equity section of statement of financial position. And if there's a revaluation loss, the revaluation loss should also be deducted from the revaluation gain previously recognized. They should be deducted from revaluation gain previously recognized. And if the revaluation gain has been extincted, then the rest of the revaluation loss is taken to the income statement. The rest of revaluation loss is taken to the income statement. So we are saying that if an asset carrying amount is increased as a result of revaluation, the increase shall be credited directly to equity under the heading revaluation surplus. However, the increase shall be recognized in profit and loss statement to the extent that it reverses a revaluation decrease of the same asset previously recognized in profit and loss. Okay. And if an asset carrying amount is decreased as a result of revaluation, the decrease shall be recognized in profit and loss. So revaluation loss is recognized in profit and loss. However, the decrease shall be debited directly to equity under the heading revaluation surplus to the extent of any credit balance existing in revaluation surplus in respect of that asset. So, and finally, we say that the item of property, plant, and equipment shall be recognized on disposal or when no future economic benefits are expected from its use. So we can give an example, we can draw a revaluation account, we can draw a revaluation account to give an example of what we are saying here. Here we have revaluation account. Revaluation account always has a debit, has a credit, sorry. Revaluation account usually has a credit balance. So we say that if there's a revaluation increase, for example, in 2021, this is a different example. If there's a revaluation increase of 20,000, then it is credited here. It is credited here in the revaluation account. So the revaluation increase of, for example, of machinery in 2021 is credited here. So this now is 20,000. If we go in the next year of 2022, and now there's another revaluation increase of 20,000, it's also going to be credited in this account. So at the end of the year 2022, your total revaluation is 40,000. However, if in 2020, for example, if in 2020 there was a revaluation loss which was recognized in the there was a revaluation loss which was recognized in the statement of in the income statement, and the revaluation loss was amounting to 20,000. So see, here you can give an example. If in 2020 there was a revaluation loss, then this revaluation gain, we would not have recognized it here. We would have recognized it in the uh, profit and loss statement to reverse that revaluation loss which had been previously recognized in the year of income 2020. We are going to do a practical example in the next lesson so that you can clearly understand what we are talking about here. So we are going to do a Cassandra past paper question. Thank you very much for attending this lesson. I'll see you in the next lesson. Thank you, thank you, thank you very much.